on our how to get a 4% mortgage rate, here was the question. And some of these aren't questions. Some of these are just comments or statements. So here goes. If rates remain high, rather than refinance, you should have mentioned a recast for the loan. No money out of pocket if you do that, and your payment gets reduced by the leftover escrow money. Okay, there's some things going on here. First, it is important to know that in most situations, when you're going to refinance your loan, which essentially means that you're going to take your current balance owed and you're going to refinance that balance, assuming that it's not a cash out refinance. That's a different type of refinance. But in this case, let's say you owe $200,000 and you're going to want to refinance that $200,000, and your goal is to either drop the interest rate or change the amortization term on your loan. A refinance will allow you to do that, and if there are costs on the refinance, in most cases, assuming you do not exceed the maximum loan to value ratios on that particular home loan guideline, then you can finance those costs into the refinance. So in that situation, there technically is a no out-of-pocket cost option on the refinance. Now, if we move over into the recast, which I love recasts, and I'm so glad that this person brought it up, a recast acts and works a little bit different. So on a recast, it's, let's say you do have that same $200,000 loan, and let's say that you have a inheritance that comes through and it's $50,000, and you want to take that $50,000 and you don't necessarily want to refinance, meaning that you're not dropping your rate, you're not changing the term, you just want to drop your principal balance. This is where a recast comes into play. It can be very helpful. Essentially, the lender usually will charge anywhere from, let's say, $100 to $300. They're going to have specific terms about what the minimum amount of the principal reduction needs to be. In our case, that's $10,000. And in that scenario, you could take that full $50,000 in this example, apply it towards your principal balance, dropping it from $200,000 down to $150,000, and then your payment is re-amortized based on that new principal balance. So it's also a great strategy for dropping your payment in lieu of refinancing without having to go through the whole refinance process or incur costs outside of whatever that flat fee that many loan servicers have. Hopefully that helps. If you have any other questions or comments, please don't hesitate to just drop them below. We'll talk to you soon.